As of 9:55 a.m. Central Time, Fiserv Inc., ticker FI, is trading at $74.26 per share. That is a catastrophic drop of $51.97 on the day, representing a complete collapse of 41.17%. The stock opened at $71.36, hitting a low of $66.58 on an absolutely staggering volume of over 38 million shares. This isn't a correction, it's a liquidation. And the most shocking part isn't just the drop, it's the reason. The company's entire forward-looking narrative, which management has been selling for quarters, was just publicly invalidated overnight. This is a worst day on record scenario, a true black swan event for a company of this size. And it stems from a complete and total breakdown between market expectation and the brutal reality of their third-quarter earnings report. This is the kind of day that forces a full, painful reevaluation of an entire sector, leaving investors who were holding this as a safe Fintech play completely wiped out. For months, the general belief surrounding Fizer was one of stable, predictable growth. This is, after all, a giant in the financial technology space. The expectation was that its merchant solutions, particularly the Clover point-of-sale system, would continue its strong trajectory, and its core banking solutions would provide a solid recession-resistant backbone. The market expected a boring, solid report. Instead, what they got was a full-blown crisis of confidence. The reality is that Fizer didn't just miss estimates, it guided down so aggressively that it suggests a fundamental problem at the company's core. Adjusted earnings per share came in at $2.04, a staggering 22% miss from the $2.64 analysts were expecting. Revenue also fell significantly short. But the figure that has triggered this morning's panic selling is the guidance. Management didn't just trim their outlook, they took a hatchet to it. Fizer is now forecasting 2025 adjusted earnings per share between $8.50 and $8.60. The street was expecting $10.15 to $10.30. That isn't a miss, it's an admission that the previous story was wrong. Organic revenue growth, once touted at around 10%, is now expected to be in the 3.5% to 4.5% range. Analysts on the calls are stunned, with one from Jefferies calling the reset difficult to comprehend and suggesting management took its eye off the ball. This isn't a macroeconomic issue, this is a Fizer issue. The new CEO, Mike Lyons, has effectively said as much, stating this tough spot is the company's own doing. This admission of internal failure is what's scaring away institutional holders. The company has announced a One Fizer action plan, but in the face of numbers this bad, it sounds like corporate jargon to stop the bleeding. To make matters worse, this chaos is being compounded by a major leadership shakeup, including the departure of the CFO and the bizarrely timed announcement that the company will transfer its stock listing from the New York Stock Exchange to the NASDAQ, changing its ticker from FI to FISV effective November 11th. It's an almost comical amount of destabilizing news to release in a single morning. What we are witnessing is a complete reset of the stock's valuation. The market is now forced to ask, is Fizer's competitive positioning, especially for Clover, fundamentally broken? Has the competition from the likes of Block and other more nimble players finally caught up and started taking real share? This report suggests the answer is a resounding yes. The trading volume is the other critical piece of this story. At nearly 39 million shares traded in the first hour, we are seeing capitulation. This is institutional funds dumping their positions, algorithms liquidating, and retail traders on platforms like Robinhood and SoFi Invest getting margin called. This isn't a small dip to buy. This is a structural repricing. Many retail investors, perhaps using self-investing tools or even Schwab Intelligent Portfolios, likely held Fizer as a core fintech position, believing it to be a safer alternative to more volatile names like Tesla stock or Nvidia stock. They are learning a very hard lesson this morning that safe, large-cap names can also hide massive, undiscovered risks. The sheer velocity of the drop suggests that automated trading platforms, like those offered by interactive brokers, are dominating the action, as human portfolio managers simply cannot react this quickly. The bid-ask spread is likely wide as market makers struggle to handle the one-sided sell orders. This is a stampede for the exits, and anyone still holding is being trampled. Let's step back for a moment and define what this company was supposed to be. Fizer operates in two main segments. The first, and the one getting all the attention, is Merchant Solutions. This is their fast-growing payments processing arm, centered on the Clover platform. Clover is the point-of-sale system you see in countless small and medium businesses, from coffee shops to retail stores. It was Fizer's growth engine, their answer to the new age of payments. The expectation was that this segment would post strong, double-digit growth. The reality is that this segment's growth has decelerated dramatically, calling into question its true market position. The second segment is Financial Solutions. This is the old Fizer, providing core processing services to thousands of banks and credit unions. This is the infrastructure that runs online banking, bill pay, and account processing. This segment was supposed to be the stable cash flow generating base. But with the entire company's credibility in question, investors are now second-guessing the stability of this segment as well. The 2019 acquisition of First Data for $22 billion, which brought Clover into the fold, was meant to create an integrated payments powerhouse. Today, that massive acquisition looks less like a masterstroke and more like a milestone. The current market action is a brutal lesson in risk management. Investors in Fidelity mutual funds or Fidelity ETFs that have a heavy financial or tech weighting are undoubtedly feeling this pain in their broader portfolios. This event underscores the critical need for diversification. Relying on any single stock, even one as seemingly established as Fizer, is a high-stakes bet. This is where many investors look for investment help, turning to platforms that offer managed portfolios or robo-advisors like SoFi Invest or the Schwab Intelligent Portfolio Service. These services are designed to prevent this exact scenario, having a single company failure blow up your returns. For those using online investing platforms like Fidelity Brokerage or the Robinhood app for self-investing, today is a stark reminder to check your position sizing. No single stock, not Apple stock, not Nvidia stock, and certainly not Fizer, should represent an outsized portion of your holdings. This is a moment for every investor to review their strategy, whether it's in a Fidelity IRA or an individual brokerage account. Looking at the charts, this drop has completely broken every technical level. The stock has sliced through its 52-week low of $117.84 like it wasn't even there. The new 52-week low of $66.58 set this morning represents a level not seen in many years. There is no support. The stock is in open water and bottom fishers are nowhere to be found. The Relative Strength Index, RSI, is deeply in oversold territory. But in a capitulation event like this, technical indicators are meaningless. The only thing that matters is the selling pressure, and right now it is overwhelming. The institutional ownership of this stock was high, and those large holders do not sell gracefully. They sell in massive blocks, which is what we are seeing. The challenge for anyone using investing sites to analyze this is that all historical data is now irrelevant. The company that existed yesterday, valued at over $126 per share, is not the company that exists today. The market is now pricing it as a low-growth, mismanaged entity with serious competitive headwinds. The future outlook is now incredibly murky. The expectation of a quick rebound is, in my opinion, pure fantasy. The reality is that Fizer has lost Wall Street's trust. A guidance cut of this magnitude is a signal of a profound failure in management's forecasting and execution. The new One Fizer plan will be met with extreme skepticism. The leadership changes, particularly a new CFO coming into this mess, add another layer of uncertainty. Analysts will be racing to downgrade the stock and slash their price targets before the day is over. The stock, which traded at a respectable earnings multiple, will now undergo a severe multiple compression. Why would an investor pay a premium for a company that just admitted its growth story is over? They won't. This makes it incredibly difficult for any investment professional to recommend